Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, if you're not on my free email list, scroll below into the description of this video and you see a link to get on it. And then you'll get my free weekly market updates. And we're in an interesting moment in the stock market, and that's why I'm doing this video. A lot of people are making note of some warning signs inside the stock market with the internal indicators. I'm going to show you those indicators in a second, and then we'll wonder or try to answer the question, how serious is this? Because back in the beginning of January, a lot of people were making similar warnings once the stock market pulled back. And I actually did an article. Again, it went out to all the people on my email list, so get on the email list in that update, saying that we were seeing a consolidation in the averages, and it was lining up as a Bollinger Band squeeze, and I thought it would resolve to the upside, and it did. And now here we are with some other similar warnings. And I think these warnings are much more serious, and I'm taking them seriously. So I want to point out that, I was saying we'd go up in a few weeks ago, and we did. And now I'm not as positive on the market as I was back then. Now, we've seen big gap ups in a lot of the most popular market cap stocks, the biggest market cap stocks. Meta, for example, had a massive earnings gap up last week. NVDA has been on a tear. On Friday, NVIDIA had a huge update to new 52-week highs. IBM also had a big gap up on earnings. The S&P 500 is up today, 8 points as I'm doing this video, made a new 52-week high on Friday as NVIDIA soared to excite people. But in the market, we're seeing some troubling signs. What's going on is these stocks that heavily weight the averages because they're so big in market capitalization are helping push things up, while we're starting to see some negative divergences inside the market. The participation of stocks on this rally isn't simply diminishing with a few stocks lifting it all up, but now many stocks are starting to decline, even though the averages are doing good. That's a negative sign. And I'm going to show you specifically what I'm talking about. Here we are. This is part of the chart gallery on stockcharts.com. Here is a chart of the S&P 500. And right here is the percentage of stocks in green above the 20-day moving average. Red is the 50-day. Blue on the bottom is the 200. And these indicators have all fallen not only since New Year's, but in the last 10 trading sessions. While the market has gone to new highs, these indicators have gone down. And that's a bad sign that, for the sustainability of the current rally. Now, when I say current rally, I mean the move since October, that rally. Now, these are my favorite indicators for measuring this sort of stuff. Some people like to use the advanced decline line, and you can actually measure the amount of up volume in the market and the down volume. And it made a new high a few weeks ago, but it did not confirm the new high made just the other day. And it's actually shifting down. And so that's a dangerous sign. The new 52-week highs has diminished. We saw a big surge in new 52-week highs in December, but on this move in January, not so much. And in fact, inside the market, there's new 52-week lows making on, not an enormous number, but it is happening. So bottom line, there are negative divergences. Most stocks inside the stock market have not been going up in the past week with the averages making new highs. In some, there's pockets of now weakness inside the stock market. So what do we make out of all this? Does this mean the market's going to crash? No, it does not. But it does suggest, I believe, that the current upward momentum in the market is in danger of stalling out and is actually likely to stall out. More likely to stall out than it did in January. We were overbought in January, and I did videos saying that in terms of indicators such as the RSI indicator. And that situation that we saw in the beginning of January, markets typically do not simply decline. Overbought readings such as RSI, stochastics, do not typically lead to significant stock market declines, but instead periods of consolidation. And that's what we saw with that Bollinger Band squeeze that I made note of in a video in that article on January the 14th. And that's why I thought it would resolve to the upside. But now we're in a different situation. And I want to always be objectively looking at what is happening and be able to tell you about that, and not merely what I want to happen. Yes, I want the stock market to go up every single day this year. I want all of us to make a killing owning stocks, but I want to also, more importantly, be realistic and tell you what I really think is going on based on what is really happening. And what is really happening is that there's a lot of now starting to be some weakness inside the stock market, significant enough to make the percentage of stocks above the 50-day and 200-day moving average, even the 200-day moving average, go down. So there's selling inside the market, masked by the gains in stocks such as NVDA, Meta, and others, IBM, but there's others that is helping the market do well in terms of the averages. So what do I think? I don't think this signals the start of a bear market, because typically you see the market spend weeks, really months, forming a top. This could be the start of a top that leads to bigger declines at the end of the year or next year, but probably not right now. What is likely to take place is a consolidation, a pullback, a bigger consolidation, a bigger pullback than what we saw in January. Instead of one that just lasts 10 days, 2 weeks, we could see one now that lasts for months. So I think that's what is likely to occur, that this is serious when the internal indicators diverge, much more serious, as I said, than overbought readings, and doesn't lead to just a 1 or a 2 week deal, but something that is likely to last for months. I think we're going to see the market, be very sloppy now for the next couple of months. Perhaps the market's going to be in a holding pattern until we finally get an interest rate cut, or it becomes very obvious when that first interest rate cut is going to happen. As the year began, traders were pricing in a cut in March. The Federal Reserve has now taken that off the table, not only with the meeting last week, but Jerome Powell, the chairman, was on 60 Minutes Sunday and said, no March rate cut, taken off the table. He said, we're going to cut rates mid-year. You can find that on YouTube. Mid-year means May or June. That's mid-year. So which month? I'm not sure. But one of those 2 months now is where the rate cut is going to happen, the first rate cut, and the market is pricing in now 3 or 4 possibly rate cuts. So basically 50% chance of 4. And when the Federal Reserve board made its predictions, call it, in December of how many cuts they would make this year, they said 3. Traders, stock market commentators basically were saying twice that many as we entered this year. Now the Fed Fund futures market is saying 3, roughly 50% chance of 4. If we started rate cuts in May, that would mean May, June, July, and then who knows if there's any more after that. So a very shortened rate cut cycle is what the markets are pricing in, differently than what we were talking about in the media was talking about at the beginning of the year. So we're some shifts are going on, and the market is likely to price in those shifts, and it's not 100% certain if it's May or June. So all this uncertainty is a justification for the market to trade sluggish, for some weakness, and we're seeing it inside the market to continue as this gets worked out. And then I do think we'll see another meaningful run in buying across the board inside the stock market in a few months from now. But now is a cautious time. The internals are saying that, and I take that very seriously. And I wanted to tell you and show you this too. What does this mean for other things besides stocks, such as precious metals? Well, I did an interview with Dave Skarica about gold and silver on Sunday. We both think that at some point ahead, and I own gold and silver, but at some point ahead of that rate cut, it would be prudent to buy more, buy on dips. But I'm going to talk I'm trying to line up an interview with Jordan Roy Bourne, who runs the dailygold.com, to get his take on what he thinks. And I'm going to talk to him about the broad stock market and what I'm just saying, and see how he reacts to this. So we're in an interesting time. Let's talk to other traders and let's hang in there and let's figure out, some good trades to line up and take advantage of this situation. And it's going to be an interesting couple of weeks here in the market. So stay tuned. If you want more analysis, hit like. If you want to get my next YouTube video notification from YouTube so you know it's there, hit the subscribe button and then hit the bell next to that, and YouTube will send you an alert as soon as that next video is up. And I'll be talking with you later.